Welcome to Knopman Notes. This series of lectures covers rule changes, regulatory trends, and other topics that are pertinent to FINRA qualification examinations. This unit will discuss the recently implemented limit up, limit down mechanism. Feel free to use the navigation tools to fast forward and rewind to repeat content as necessary. We hope you'll find this information helpful as you prepare for your exam and even slightly interesting. My name is Brian Marks. I will be reviewing this Knopman Notes unit with you. If you have any questions about this topic or about any other topic concerning your FINRA qualification examination, please don't hesitate to contact me at my office, on my cell phone, or via email. I encourage you to use social media to keep in touch with us. Okay. Anytime there's a rule change or pertinent information on a FINRA test, okay, we post it to Twitter, we post a YouTube snippet such as this one, and we post it on our blog. So it's very, very important before you take your exam that you peruse our variety of websites to ensure that you have all the latest information. In many cases, when rules change, those topics will show up on the exam as soon as the very next day or the following week. We would also very much appreciate if you'd like us on Facebook and connect with us on LinkedIn. This particular unit will review limit up, limit down. Limit up, limit down is a rule that has been enacted in phases throughout 2013. Okay. It's largely a response to significant volatility events in equity markets over the last 3, 4, 5 years, from 2008 through 2013. Limit up, limit down is pertinent to a number of different FINRA examinations. Okay. The most popular FINRA exams to which this topic is pertinent include the Series 7, the Series 10, and the Series 24, along with the Series 55 examination. If you are taking one of those examinations, this is definitely a topic you should be familiar with. You should expect to see a number of questions on this topic on the examination. The way this unit is organized is we'll start with the top level summary. What is the purpose of limit up, limit down? What's kind of the punchline? Then we'll go through all the details, all the guts, and then at the end I'll come back to the punchline. I'll try to summarize it in 1 or 2 sentences. The purpose, as I mentioned on the previous slide, is to address extraordinary market volatility in U.S. equity markets. And it does so by preventing trades from occurring in equity securities and in certain equity securities outside of a specific price band. And I'm going to talk about all that in just a few minutes. The consequence of limit up, limit down is it can potentially lead to a 5-minute trading halt in an equity security, or, depending on certain circumstances, possibly longer than a 5-minute halt. Okay, so let's get into the specific mechanics of limit up, limit down. And it takes a few slides to paint the full picture of this. So we're just going to take it one piece at a time. Let's first discuss the reference price. Limit up, limit down, as you can see here, permits trading within a price band around a security's reference price. Okay. What is the reference price? And I'm going to talk about the price band, by the way, in just a second. But what is the reference price? It's calculated as the security's, a stock's 5-minute moving average. Okay. That reference price is recalculated every 30 seconds by SIPs, Securities Information Processors, okay, like the Consolidated Tape or Bloomberg. Okay. But the reference price is only updated if the new calculation, 30 seconds later, is more than 1% away from the current reference price. So that means that if the stock is kind of range bound, then the reference price will just stay the same. For example, let's say the current reference price is $100. Again, the reference price is the 5-minute moving average. And SIPs calculate the new reference price 30 seconds later as $100.37. Well, because that's less than 1% away from the current reference price of $100, the reference price just remains $100. So the reference price is the 5-minute moving average, but is only updated if it moves by more than 1%. One other side note, after the open of trading, in the first couple minutes of trading, the first reference price of the day is the opening price. If the stock does not open with a print, which means if there's no trading at the open, then the first reference price will be the bid-ask midpoint. So if there's no trading in the security at the open, the reference price will be the bid-ask midpoint. I mentioned on the earlier slide that trading is permitted within a price band around the reference price. So we talked about the reference price, that's the 5-minute moving average. What is the price band? Well, the price band is the allowable deviation from the reference price. Okay. What is the price band? Well, for S&P 500 stocks and Russell 1000 stocks, and for stocks on those industries greater than $3, the price band is 5%. For other NMS stocks, it's double, it's 10%. Reg NMS stocks, what does that mean? That's regulation NMS. Generally, a Reg NMS stock is an exchange-listed security. So this rule applies to all exchange-listed securities. Stocks that are part of the S&P 500 or Russell 1000 have smaller bands, and other exchange-listed securities that are not on one of those indices have a larger price band. For stocks trading between 75 cents and $3, the band is 20%. And for stocks trading below 75 cents, the band is the lesser of 15 cents or 75% of the reference price. So what we're talking about here is the allowable deviation from the reference price. So for example, for an S&P 500 stock trading for 30 bucks, 5% of that would be $1.50. It can fluctuate up or down by $1.50. Also, given that there's more volatility during the open and close of trading, those bands double in the first 15 minutes of the day from 9:30 to 9:45, and in the last 25 minutes of the day from 3:35 to 4 p.m. They double during the first 15 minutes, and they double in the last 25 minutes of trading. That's to allow more natural market volatility. We've talked about the reference price. We've talked about the permitted price band. What happens when the stock tests one of those bands? When the stock tests one of those bands, it is said to enter what's called a limit state. A limit state does not mean trading is halted. We'll talk about what happens in a limit state in just a second. Let's talk about how you would enter a limit state, though. A limit state occurs when the best bid in a stock equals the upper band, not the lower band, but the upper band. So if it's bid way up, or if the best offer equals the lower band. So if it's offered way down. So if the stock is bid up, or if it's offered down. As an example, let's talk about ABC Corporation common stock, which is part of the S&P 500. And the current reference price is $50. And given that the stock trades over $3 a share, the price band is 5%. We talked about that on the previous slide. Okay. So the permitted price band is $250. So therefore, the stock can trade within a range, $47.50 at the low, $52.50 at the high, plus and minus the reference price and the price band. So what would trigger a limit state? Two things could trigger a limit state. If the stock is bid way up at $52.50, or if it's offered way down at $47.50. If the order happens to be priced aggressively outside the band, let's say somebody comes in and bids way above $52.50. So not at $52.50 but $55, or somebody offers the thing for $45. That's called an order priced aggressively outside the band. Those orders are subject to what's called a price slide, which means they're modified by the system, either NASDAQ or NYSE. there's a price slide to the band. So for example, let's say somebody comes in and offers the stock way down at $47 through the band of $47.50. Well, that offer is at 47 is priced back to 47.50. But again, that's going to lead to a limit state. So again, when do you enter a limit state? Well, if it's bid way up at the top of the band or offered way down at the bottom of the band. How long does the limit state last? It lasts for 15 seconds. What happens during this limit state? Well, trading continues during the limit state. What doesn't happen during the limit state? Well, there are no new reference prices and no new price bands that are updated. So unlike the rest of trading, when SIPs are constantly recalculating the reference price every 30 seconds and the price bands are being updated, this doesn't happen during the 15-second limit state. Two things can happen during the limit state. First, all orders at the price limits, effectively the orders that cause the limit state, are canceled or executed. So in my previous example, those offers that came in at $47.50 that caused the limit state to occur, well, if all of those orders are either executed or if all of those orders are canceled, all of the shares at that price band, at the threshold, all of the shares being offered at $47.50 would have to be executed or canceled. Then what happens? Then you exit the limit state. There was never a halt. Trading continues. Limit up, limit down continues as we've been talking about. There's never a halt. It's kind of like a test period. So if it just tests the band and then comes back in, orders are executed or canceled, good to go, you move on. Let's say trading continues at the band, or 15 seconds later, that interest, that offer at $47.50 remains out there at the price band. Well then, there is a 5-minute trading halt in the security. So if trading continues at the band, you're going to see a 5-minute halt. So one of two things can happen. Either you test the band and those orders get executed or canceled and trading continues, or 15 seconds later there's still available interest at the price band, and then you're going to have a 5-minute halt in that stock. Let's say this does lead to that 5-minute halt. What's going to happen? Well, new quotes can be updated and new orders can be entered, unlike, let's say, a circuit breaker when all equity market trading is halted. And unlike a circuit breaker where no orders can be entered, no quotes can be updated, during a limit up, limit down halt, orders can be entered and quotes are allowed. And after 5 minutes, the primary market, which is typically NASDAQ or NYSE, will choose when to resume trading. The primary market will choose when to resume trading. If after 5 minutes the primary market is not ready to resume trading, for whatever reason they're unable to resume trading, they can extend the halt past 5 minutes. However, if after 10 minutes the primary market is still not ready to resume trading, well, if that's the case, then other markets can subsequently resume trading in the security. So for the first 5 minutes, after 5 minutes, the primary market can choose to resume. If they're not ready, they can extend it. And everybody else, all other exchanges, third market trading, has to follow the primary listing place. But after 10 minutes, if the primary exchange still is not ready to go, then other listing places can choose to resume trading in that security. So you only have to follow the leader for 10 minutes. Okay. So now that we've talked about the mechanics, let's come back and revisit the bottom line. So what's the bottom line here, summarizing these last couple slides in one sentence? If a stock is quoted 5% away from its 5-minute moving average, that's the price band and the reference price, and it stays that way for 15 seconds, that's your limit state, then trading is halted for 5 minutes. So again, if a stock is quoted 5% away from its 5-minute moving average, and it stays that way for 15 seconds. Trading is halted for 5 minutes. Okay. That 5% price band will double to 10% at the open and close. But for certain securities, it can go as wide as 40% based on the chart that I showed on the previous slide. So the 5% I here use as an example, that's really for S&P 500 and Russell 1000 stocks trading above $3. If it's trading below $3 or if it's not, an S&P or Russell 1000 stocks, the price band is different. And remember, at the open and close of trading, the price bands are double to allow for additional volatility. Limit up, limit down is a complicated concept, especially for those of you who are not involved in equity trading. Hopefully, you found this Knopman note useful in explaining the concept. Again, depending on the exam, you should expect to see it tested. In some cases, again, it'll show up the day after it goes into effect, and this rule has been going into effect throughout 2013. It will be fully effective beginning 2014. If you have any additional questions, you can email info@knopman.com. You can contact our office, and you have my contact information at the beginning of this presentation. Thank you very much, and best of luck studying.